Is the labor market too strong for the Fed? Hi, everyone. Welcome to the Real Vision Daily Briefing. Here with me this Jobs Friday is Peter Boockvar, CIO of Bleakley Advisory Group and the author of the book report. Hi, Peter.
Hey Maggie, how you doing?
I'm doing okay. Well, it certainly seems like the stock market's answer to that question is a resounding yes, it is too tight. We saw a really sharp sell off that kind of accelerated into the close, although it looks like we just picked up a little bit off the lows as we settle here. The Nasdaq had been down 4%. Looks like it's going to be around 3.8%. S&P 500 looks like it recovered a little bit too, from down from over 3% to maybe something around 2.8%. But it was still a tough day for equities. The 10-year yield, not as much as a response there, maybe 3.89%. It looks like it's settling at. What did you make of the monthly jobs number?
Well, the jobs number itself was pretty much in line. It was the drop in the unemployment rate that sent the futures down the second it hit the tape. 3.5% because of an increase in the household survey at the same time that the size of the labor market, the size of the labor force actually shrunk because people were anticipating at best a flat unemployment rate or maybe even a tick up. But keep in mind the psychology of the markets the last couple of weeks. It's been sort of this desperate hope that there would be some central bank that would see the slightest knees buckle or an economic data point that would be soft enough to get the Fed to back off. I mean, that's been the mentality of the markets here. And that certainly was a catalyst for the Monday-Tuesday rally because it came on the heels of last Friday when Lyle Brainerd sort of hinted that she's focused on the risks to what they're doing. But that was then quashed by a variety of different speakers from the Fed this week who used to be uber dovish and now all of a sudden are uber hawkish and all basically said we're going to continue to take our sledgehammer and bang on inflation, whether it hurts you or not. And then, of course, the unemployment rate going down instead of up was all the market needed. Plus, so this wasn't just a payroll thing and a rate thing. You also had the news from Advanced Micro last night reminding everybody that the global economy is in a downturn and that technology is not immune. And that's what we have to look forward to over the next 6-7 weeks is probably a minefield-filled earnings season.
Yeah, I'm really glad you mentioned that, Peter, because I think that didn't get as much attention as the jobs report, and that those, starting to drift through in the earnings and those warnings and the earnings hit that everyone's expecting that hasn't come yet. I mean, I think that's also a really, really big part of that. It's really interesting on that point. Earlier today, right after the jobs number came out, I spoke with Julia Pollak. She's a chief economist at ZipRecruiter, which is a huge online job site. And I asked her about, where the strength is coming from in the labor market, especially when you have so many people worried about recession. Here's what she had to say to that.
Well, during the pandemic, people actually received more income than they would have received otherwise, and they spent less. And they also took advantage of once-in-a-lifetime conditions like record low interest rates and mortgage rates to improve the health of their balance sheets. So about 2/3 of U.S. mortgages right now are 4% or lower monthly rate. Only 2% of mortgages are adjustable rate mortgages. And so even as the Fed is ratcheting up interest rates, the majority of U.S. households are not really feeling it. It's not as though their monthly costs of paying for their homes are going up in any way. And so they're still sitting on savings. They've also been gaining jobs at such a healthy pace in recent months that they're getting more and more labor market income. And wages, while obviously inflation has been eating away at those increases, many people have received very high wage increases. So what we're sort of seeing is what some people are referring to as kind of an immaculate slowdown, where companies are reducing future headcount growth goals, but they're not cutting headcount. And so, yes, we are seeing job openings come down. On Tuesday, we saw the biggest drop in JOLTS data in job openings outside of the pandemic. 1.1 million job openings vanished. We've been seeing that for several months on our platform, that companies are becoming more cautious, more conservative. They are focusing on hiring to replace turnover, not so much to expand and grow anymore. They're focusing on hiring essential staff, essential workers, those very, very important roles. They're not, sort of willy-nilly rolling out new product lines and new locations growing at all costs. They're being far more conservative, and their plans going forward are to harden themselves against the possibility of a downturn. That said, they're preparing for a downturn in sales and revenues that just doesn't seem to arrive. And so when push comes to shove, they're having to hire just to meet their immediate business needs.
It was so interesting to hear that. That's a little sneak peek, by the way, of the full interview that'll be releasing next week. So it's not out yet, but it's part of our Make or Break series on inflation, and it will be available on the website. And I love trying to tease out, because I feel like they have a kind of real time take on what's happening on the jobs market. But Peter, this raises things. So we've got earnings. We've got that earnings warning from A&D. Maybe it's the first shoe to drop. And yet we see all this tightness, and we hear Julia talking about, listen, these companies need to hire. Like they've got to run their operations. They still feel that need to hire. Great question from Tabuena on Twitter, which speaks to this timing issue, I think. And they ask, interest rate increases take time to work, yet the market seems to extrapolate the state of the labor market. Is that right or wrong to think about? Peter, how are you thinking about that lag in policy?
Well, it's right on that it is a lagging figure, and not just payrolls being a lagging figure in terms of gauging the state of the economy, but also the lagging nature of those interest rate increases. From a labor market standpoint, you're an employer. If your business slows, you don't just quickly fire people, especially if it took you years to develop that labor force to your needs, both skill wise and body wise. So you're going to hold on to those employees, and you're going to maybe cut some other costs. You'll be a little bit more suspect on further hiring, but you're going to keep tight on who you have. Mm-hmm. Only then, if you take that a step further, if business starts to deteriorate and you run out of costs to cut, then maybe you start to trim. So that still is to come. So basically, you really need the deeper economic downturn before you start to get the weakness in the labor market. And while we definitely have seen a notable slowing in the economy, it's only leading to job cuts in certain areas. Now, if you're in the mortgage business, chances are your job is on the line here. If you are in tech has been the place where everyone invested a lot of money over the last 5 to 10 years. And a lot of these tech companies, whether it was an existing publicly traded one or a VC funded one that just went public through a SPAC or an IPO, can just imagine all the hiring that took place in that industry. And it was a competition for workers. And it was, I need to get my hands on the best programmers and coders. And there was definitely in that a lot of overhiring. So that's where tech companies right now are beginning to limit hiring, and they're probably cutting as well. But then on the other hand, the local restaurant or hotel or certainly the airline industry can't find enough people. And I think that we've seen just an unusual economic backdrop where things are clearly slowing. The situation overseas is worse, but companies are keeping tight onto their workers, depending, of course, like I said, what industry you're in. At the same time, labor is gaining a bigger piece of the profit pie, and they have more leverage, and they're getting 5% type wage growth is what we saw in average hourly earnings on a year-to-year basis. Every single month this year, we've seen a 5 handle in wage growth. And while that's still well below the rate of inflation, it's sticky wage growth that I think could continue, maybe at a slightly slower pace, but something that I think can continue.
And that's why we pose the question, right? That speaks to why the Fed, it's not that, that they don't like a tight labor market. It's because of the sticky wage inflation, right? That's why this is such a closely watched area and so important to the Fed.
Yeah, because the Fed thinks, okay, if wages are going to remain sticky, then companies are going to keep raising prices in order to offset that labor cost. I mean, for you're a service company on average, 2/3 of your expenses are labor. It's the biggest chunk. So that's why the Fed is focused on it. But it's just this complete upside down thesis of the Fed is originally they wanted inflation because they think that higher inflation would lead to stronger wage growth. And now they want to cut down wage growth while inflation is still high. It's somewhat backwards, but yeah, that's what they focus on. But the bizarre thing about the Fed, for all the PhDs they have and for all the economic brainpower they claim to have, they look at things in a very narrow lens. All the extreme easing post-COVID or post the initiation of COVID was we need to get the jobs back that were lost due to the shutdowns. And we don't care about anything else. And we are going to burn every tree down to print as much money as we can and have rates at zero because we need those 6 to 7 million jobs back before we do anything. Not caring about what the inflation story was or all the unintended consequences of doing what they did. Now it's the opposite is we don't care about anything else. We need that inflation rate to come down. And that's it. That's the only lane they're driving down. The problem with that is their front view window in driving down that road is actually looking at data that is getting older and becoming more dated and is not as accurate. And therefore, it's getting to my growing concern that while I am okay with the destination at which the Fed wants to take the Fed funds rate, call it 4 plus, because that would at least get it closer to where inflation is, assuming inflation continues to fall. But it's the pace, the speed, the velocity at which they're hiking that now I have a huge problem with.
Yeah. No, it makes perfect sense. And you're right. We've got now that we got all the jobs back or most of the jobs back, they're freaking out about what they intended to do. And it is confusing. So I have another question, Peter, as well, that I would not only like to ask you, but I'd like everyone to weigh in on, everyone listening. We have a little poll up in the chat. You can go to Twitter and tag Real Vision, use the hashtag AskRV, or go in our comments section. But in this whole conversation about what data they're looking at and this issue with wages, we were talking about this as the editorial team earlier today before the show. Can we really have sticky wage inflation when everyone knows that you can be fired at the drop of a hat? We saw that happen in COVID. That was one of the lessons out of COVID. Okay, this pandemic hit, bye, you're done. So if you have no job security, how can we really have sticky wage gains? Just because you have that raise now or you have that salary now, who's to say it won't disappear tomorrow? I mean, that is kind of collectively and anecdotally what a lot of us have seen, whether through ourselves or being a contract worker or, from relatives that we have or from anyone. Like, there doesn't seem to be anything like job security anymore. So how do those wages get structurally built into the system? Peter, if you can answer that. The rest of you, how do you feel about this? Do you feel like if you get a raise that it's going to be there for you? It's sort of structurally now part of your life, or do you feel like it's fleeting? Peter, can you weigh in on that? Like, how does that work?
So it's important. So to answer that question and to think about that, it's best to segment the labor force. Okay, so let's take the part of the labor force right now where you physically have to be at work, okay? Whether you are you work at a restaurant where if you're going to cook the food, you physically have to be there. You can't virtually cook the food. If you're a flight attendant, you can't virtually be the flight attendant and walk down the aisle and serving us food and drink. You have to be there. If you need to clean a healthcare facility, you need to physically be there. Those are the people that are seeing the stickiest wages. Now they don't, unless you're in a union, they have contracts, so they're sort of protected. But let's just say you don't, there's still demand for what you do because those businesses need you, but there's less of you. That's where a lot of the labor shortages have taken place. If you're a white collar worker, if you're working at a law firm or in corporate America, for example, yeah, maybe you have a contract or not, but your job is not safe. That's where the wage stickiness is less. So that's where we're seeing sort of this bifurcated labor market where a certain area is going to have leverage when it comes to those wage negotiations. And those are, call it in the BLS number, the non-supervisory workers. The supervisory workers, while they have sort of seniority, well, they actually have less leverage, and they're going to see, and they have seen, smaller wage gains.
Does one offset the other in the economy?
Well, in the aggregate, I mean, just look at today. We saw a 5% year-over-year average hourly earnings. Now, that's a slight downtick. It's actually the lowest of the year, but it still is as a five handle. And yeah, that's the question: is one going to offset the other? You know, we saw strong wage growth today in leisure and hospitality. We saw it also in trade and warehousing. I mean, transportation of goods is slowing, but if you have a warehouse facility that needs to store a lot of the excess inventory, well, you know, you're in demand for to be working at that warehouse. So that's how I would sort of look at the labor market, and that sort of gets to, you know, we had this sort of two-way economy for the last couple of years where everyone spent money on goods and not services, and we've flipped that around. It's just it's as opposed to like a regular recovery where things move in the same direction together. This is definitely different in how it played out in the expansion side and how it's now playing out in the slowdown side.
Yeah. But this is where understanding the labor market gets really tricky, right? Because I mean, there are just shortages of those people. So if the Fed throws the economy into recession because it's trying to stamp out wage inflation, companies will fire the people that they can replace. They'll fire the ones that you described in the other part of the economy. They're not going to get rid of the ones who work in the warehouse because they just simply need them. They can't get rid of them, right? So how does that achieve their end?
They need them, and it took a long time to find them. You know, one of the interesting things about the jobs data today is, you know, you have the establishment survey and you had the household survey. Within the household survey, about 380,000 jobs, all of the jobs in the household survey came from people with less than a high school diploma. Now, you think that most people, if they didn't go to college, they at least graduated high school. These were a lot of people that did not, and which I found pretty interesting, and also older people as well. So now I don't know whether that's because people, the inflation story that we're in, they need to get back to work or whatever. But it's interestingly enough, again, where the companies that need you to physically be in a place, that is where the wage gains are more persistent.
Yep, absolutely. And much of this reflected in what Julia is seeing as well, you know, in terms of where that sort of bargaining power is on the part of labor. We have a question if you have a question for us, drop it in the same place, chat, Twitter, or in the comments. Question from Dodging Durangos. Given the lag in interest rates effect, does inflation still tend to have any residual upward momentum despite the Fed's action? Inflation spikes in the next reports, ? We have a big CPI report coming up next week, right?
So in terms of the reporting, the inflation acceleration will continue to be on the services side. Now, services inflation is always persistent. It's just a matter of to what degree of persistency do we get. And I've said this before on the show, the 20 years leading into COVID, services inflation ex energy averaged 2.8% per year. That's pretty consistent. Now we're going to continue to see in the BLS data further acceleration in the rent component, even though in real life, rental increases are slowing down. That gets to, you know, the Fed driving down one side of the road and the inflation stats driving down the other side of the road at this point. On the good side, we're definitely going to see further moderation, but just a matter of to what degree. But keep in mind, even if, you know, we're seeing deceleration in certain commodity prices, we're seeing deceleration in transportation costs and used car prices. But just because that doesn't immediately translate into a fall in prices broadly. You know, the used car prices, they're falling on the wholesale level. It takes some time to work through the retail level. The fall in transportation costs are good for companies, but it takes some time for it to flow through. There was an article in the journal today about Costco. They're seeing a decline in some of their costs, but they're not cutting prices just yet because they have they have a couple of years of massive price increases that they've had to absorb that they're just not going to give away by quickly cutting prices.
Mm.
And I've also said before, if my cost structure goes up 30% a year, I'm not raising prices to customers by 30%.
Mm.
So even if those cost pressures start to recede, I still have margin left that I need to recapture that I'm going to continue to. So take Conagra, a stock we own, full disclosure. In their quarter that they just announced yesterday, they raised prices by 14% in the quarter. They lost volumes. So they had a good revenue number because of price at the expense of volumes. But they said, and this was their first quarter of their 2023 fiscal year, and in this quarter and the next quarter, they're still going to see double-digit price increases. It's only going to be the second half that things are going to slow down because the way that things recycle through the chain. But on a rate of change, inflation is definitely going to be slowing, but it's going to take time to work itself through the data.
Yeah. And again, I think that feeds into your worry, right? If that's what the Fed is focused on and they're kind of looking at backward looking indicators, that raises the risk of a policy overstep. David on Twitter, talking to the question we put out to everyone, I can count on below inflation rate annual pay increases. I have to add another stream of income to get ahead in real terms. David, we feel you. And I feel like a lot of us struggle with that, which is why this is interesting and frustrating, I think, for many to hear about a Fed engineering a recession to try to get a handle on inflation. Peter, we have a question from Golan Heights. Less than 65% labor participation. What if 5 to 10% come back? Do we see deflation, inflation? What would happen if we see an increase in the labor participation?
Well, all we need is a few tenths, let alone, five. Yeah, all we need is a few tenths more to come back to raise that percentage. And yeah, that would be a nice supply of labor, at least for a portion of the labor force that needs it. There's no question that would help. And it would also certainly relieve the Fed's concern with the wage gains that we're seeing, because the Fed also pays attention to that participation rate as a gauge of how tight or not the labor market is and what that means for wage gains. So it would be nice, but you wonder, if it hasn't happened yet, why would it all of a sudden happen? And yeah, maybe some people do need to come back because of inflation. Like I said earlier, we did see people over the age of 55. We saw a job gain there. Maybe those baby boomers that retired need to supplement their fixed income because of inflation. It would relieve some of the sort of shortages that in certain areas of the labor market, as I keep saying, need it. Another company that I think is a good anecdote that we happen to own is ABM Industries. I bring them up because they have 125,000 employees. It's a very labor-intensive business with almost 70% of their cost structure being labor. And the way that they termed the situation in the labor market is that it's a battle for labor. It's a fight for labor. And even with the slowing economy, there's still a need for bodies to fill certain roles. At the same time, like I said, tech companies are overhired and they're trimming back.
Right. It's funny because it's going to be such a flip. It was a time when the industrial sector was where, jobs were disposable and high tech. And, if you're a computer programmer, you were in the driver's seat. Timothy from YouTube asking a great question. Peter, HYG is the next thing to drop, or can treasuries be down 30 to 40% and junk 15? When does junk have its crash moment? Junk is outperforming treasuries and stock. Effing amazing. Timothy, a lot of people, I think, agree with that sentiment, and it has been unusual. How do you see that? Are they going to catch up? Is it imminent, Peter, that we see high yield reacting?
Well, I like to look at the triple C category, and I haven't checked it the last couple of days, but early this week and late last week, that triple C yield to worst is now at 15%. Yield spreads have not widened to where it was in June, but you have that kind of cost of capital, it is inevitable that yield spread is going to widen. One of the reasons why some of the high yield paper has not declined worse is, number one, the economy is still sort of hanging in there. Mm-hmm. So, but we have to again wonder how sustainable. And number two, the yield has been higher than treasuries and has sort of offset and mitigated some of the loss in the price of those bonds. So if your starting point in high yield was, call it 5 to 6%, versus your starting point in a 10-year treasury going into the year of, I can't remember, maybe it was 2, you have less cushion in terms of mitigating some of that capital loss with higher coupons. Now, from here, I do think that most of the move, and to his point, in both investment grade and high yield has been the rate move and less so the spread. But if the economy does soften, that spread widening is going to contribute to further losses in high yield.
Yeah. Peter, we had Diego Perea on yesterday, and throughout our conversations, we're looking hard at this macro environment. We've got our series Make or Break that's looking at geopolitics, China, energy, inflation, and there is a sense that we have some problems, and that while you see the real economy, as you just say, hanging in, that there are strains. And Diego was concerned yesterday about leverage, hidden leverage in the system. I know we've heard many people come on and talk about something breaking. Are you concerned, and where do you think that would happen? What's your level of concern?
You have to be concerned but the Fed and other central banks, when they went from over-medicating us for the last 2 years to now conducting interest rate shock therapy. There is no doubt more accidents are going to happen. And whether it was the liability-driven investment situation in the UK, where UK pension funds got a little too cute with their search for yield, but some of that stuff exists here in US pension land as well. And we'll see what happens there. So there are definitely going to be more accidents. But sometimes it doesn't have to be some sort of dramatic accident. Sometimes it can be a death by 1,000 cuts that happen, in the sense that we are in a higher cost of capital environment, and it just makes it more difficult for businesses that didn't term out their interest expense or their debt exposure and have floating rate debt that are going to be crimped by a slowdown in the economy at the same time their interest expense has jumped. Now, that is, you can call it an accident, but that's not, that's like an accident here, an accident there. Now, in the cumulative sense, it adds up to a lot of problems. But an accident like, 2007, 2008, I'm sure there'll be some here and there, but not to the extent. I'm more worried about just a global economy that is having to deal with the higher cost of living, a higher cost of doing business, and higher interest rates on top of that, that we're all going to have to deal with. And in the aggregate, it slows growth, it slows activity, it compresses valuations, and it's something that we're just going to have to grind through.
JM on YouTube is asking who bought a bunker. And it does feel a little bit like that. But that's a really, really fantastic point, Peter. And I think that is going to be my takeaway from this conversation with you, and I think it echoes maybe what Brent was saying to us also, that we've kind of conditioned to think there's going to be a blow up, and the central banks are going to be forced to come to the rescue, not because they feel like they've beat inflation down, but because it's so bad. But then that kind of clears the way for a V bounce in a way, doesn't it? Like, we get it out, we get it over with, and it's painful, but then we can carry on. And what you seem to be describing is something that's much slower and almost just like a really long, nasty sideways slog where it just sucks. Everything, it's just hard. There are no earnings. It's hard for the individual. It's hard for companies. It's hard for the global economy, and just no one does really well. Is that what you're saying? Is it that grim?
Because when you think about where was the excess the last couple of years? Where's the excess been the last 10 years? It's been in sovereign debt land. That's where the biggest financial bubble in the history of bubbles was in sovereign bonds. Now, granted, there's been collateral bubbles all throughout the system. I mean, when high yield in Europe was yielding 2%. Obviously, high yield became an oxymoron. So there were definitely excesses surrounding that, but it was really in the sovereign debt land. So we're going to now adjust to now when you want to talk about blowups, maybe it's governments, maybe it's the U.S. Treasury that has a failed auction because the Fed's doing QT and foreigners buy less of our treasuries and banks are buying less of our treasuries, and all of a sudden you have a rate gap higher in the 10-year because we have a crappy or failed 10-year bond auction. Those are some of the risks. For the private sector, I think it's going to be this really slow, painful adjustment to this higher cost of doing business environment that, it's going to create a level of bankruptcies for some and a slog for others.
Yeah, and I guess that's the painful deleveraging, right? That's just
Yes.
hard. We know that from in a way from what we had to go through with housing and the consumer balance sheet. So let's end on Oliver's question. He was one of the first to post it, Oliver, from our site. Thank you, Oliver. And I think we're all thinking about this. Question for Peter. Other than stocking up on wood for my fireplace, what should I be doing from an investment point of view for this quarter to prepare for the first quarter of 2023?
I would still be owning the precious metals. They've acted very well the last couple of weeks. Still own energy stocks. I'd be buying the 2-year treasury at a gift yield of 4.3%, which I think fully captures where the Fed will at most take the Fed funds rate and maybe not even make it there. And I think that there are plenty of cheap stocks and opportunities that are being created here if you have a time horizon more than just a year or two.
Fantastic. And I know that that's Peter's specialty, is doing a deep dive into those companies and looking for the value and sort of hunting out what other people aren't seeing. Peter, it was so great to catch up with you. By the way, I can't forget to tell you the results of our poll, which was really interesting, just about 50-50. Now it says 51 no, 49% yes. So really split on that, which to me is fascinating. And I think Peter probably speaks to your comment about it depends on what part of the labor market you're sitting in as to whether, how you feel about wages and that issue of job security. But that was fantastic. Thank you all for taking the time to answer that. We're going to continue to sort of deep dive into these issues because as my colleague Ash Bennington has said many times, this really is a macro moment and it's very important for us to sort of, tease out all these different angles. And Peter, we appreciate you helping us do that today.
Thanks, Maggie. Great to talk with you.
So I know a lot of you probably have more questions, especially when it comes to what to do and how to be thinking about this macro framework. Great news. Our Real Vision co-founder, Raoul Pal, is going to be doing an Ask Me Anything session live in 1 hour's time right here on the Real Vision finance channel on YouTube. Right here, 1 hour. So get yourself a snack, come on back. Be ready with your questions, and let's see if we can't navigate through this together. Thanks so much for your time today. Take care and good luck out there.
The Sri Lankan Prime Minister's house set alight.
The first is authoritarianism. The second is corruption.
The FOMC is strongly resolved to bring inflation down to 2%.
Home builders are abandoning homes unfinished.
Massive protests going on here.
We're going to see a material impact here on growth and indeed on earnings, which my colleague...
Change is happening and you fear it. You're not going to stop it.
There are really only 2 countries in Europe that have managed to maintain a replacement level birth rate, France and Sweden.
This is the biggest bubble in the history of the world, and you have no clue.
It's all herd mentality. It's the same as the property market.
What happens over the next few months could define what happens over the next few years. So we want to make sure that you understand why. You've probably realized that we really have been listening to you.